Good evening once again. This week, the market told us two stories at once. Tech got punished, and the economy underneath it stayed strong. So let me walk you through the entire week of what happened and what it means for your money and what exactly to watch for Monday. So on Monday, it was the setup. Markets opened the week lower. Healthcare and industrials dragged, not tech. Sentiment was cautious, investors positioning ahead of the biggest earnings week of the quarter. Alphabet, Tesla, Intel, all of them reporting. Nobody wanted to commit capital before seeing those numbers. This was the calm before the storm. Now Tuesday, the tease. Semiconductors rallied hard. Micron jumped over 10% after Morgan Stanley predicted memory chip prices would keep climbing on AI demand. Intel, Nvidia, and AMD were all up. S&P 500 rose about 1%. Nasdaq led. Even the Brent crude pushed above $90. The market did not care. It was all about AI earnings anticipation. This was the market betting that the earnings would confirm the AI spending thesis. They were wrong, somewhat. On Wednesday was the wait. Markets dipped, Dow basically flat, down 6 points. Nasdaq modestly lower. Healthcare gains offset bank weaknesses. Investors were frozen, waiting for Alphabet and Tesla to report after the close. The market held its breath. Then Thursday was the storm. This was the day that defined the week. Alphabet reported strong revenue, but capex doubled. Margins were compressed. The market did not reward that revenue. It punished the spending. Alphabet dropped 7%. Then Tesla. Tesla missed on earnings and the stock plunged 14% in a single session. That's not a dip, that's repricing. At the same time, Brent crude broke above $100. Houthi fighters attacked two Saudi oil tankers in the Red Sea. President Trump threatened Iran with major military punishment. Two body blows hit the market at once. AI spending fears from earnings and the oil geopolitics from the Middle East. Nasdaq sank over 2%, S&P dropped over 1%. The Dow held up better because industrials and healthcare carried the weight. This is where the rotation became visible. And Friday, the fade. This morning, your portfolio most likely flashed green. Oil pulled back for the first time all week, down over 3%. That relief bounce was real, but very short-lived. Intel reported earnings after Thursday close. They beat on revenue and EPS. Stock jumped 4% pre-market, then reversed down about 5%, trading about $95, which I mentioned in my stories. Investors questioned whether the foundry revenue growth was real demand or just asking weak external demand. Apple was the bright spot, up 3.5%. Investors are rotating to low capex AI. Apple uses AI without building data centers. In the market questioning AI spending, that's the premium. When Flash PMI came in, composite hit 53.6, an 8-month high. Services are surging, but manufacturing entered contradiction. That's the underneath story. By the afternoon, the oil relief faded and markets drifted lower again. So here's the full week picture. Monday was cautious, Tuesday was hopeful, Wednesday was frozen, Thursday was punished, and Friday was faded. The Nasdaq had its worst week in months, but the Dow barely moved. That gap between Nasdaq and Dow is the entire story. Tech is repricing what AI costs while the rest of the economy keeps chugging. This isn't a market crash. It was a sector rotation. Don't panic. Don't get mad at yourselves. It's okay. The money did not leave. It moved from high capex AI infrastructure to low capex AI applications into a non-tech sectors like industrials and healthcare. So here's what to watch next week. Monday the 27th is durable goods orders at 8:30 a.m. This tells us if businesses are spending on equipment. Then the first read on Q2 GDP, the advanced estimate. If GDP confirms 2.3 growth pace at today's PMI data implied, it reinforces the economy is fine underneath the tech noise narrative. Wednesday, July 30th, is the FOMC interest rate decision. This is the big one. The Fed meets. Nobody expects a rate cut with jobless claims at 187,000 and the labor market is strong. But the language matters. Watch for any mention of oil inflation concerns from the Red Sea situation. On Thursday, the 31st, Employment Cost Index on Q2. This is the Fed's preferred wage inflation measure. If it's hot, rate cut expectations push further out. If it's cooling, the Fed has flexibility. Plus, the Bank of Japan meets July 30th and 31st. If they hike rates, it could trigger more volatility in global markets. Now my guided actions for you, my two lanes. If you're a long-term investor, this week was just noise. Your action is pretty much to hold. There's no need to trim, there's no need to take out money, there's no need to rebalance. Keep your monthly contributions running. The rotation is happening right now from high capex tech into value, dividends, and industrials. This is exactly what a diversified portfolio is designed to handle. If you copy my portfolio, you should already have all of this covered. If you don't, you're more than welcome to join our communities and apply for a free founding member. SCHD was green all week. Bonds provide your ballast. Your plan doesn't need adjustments because a few tech stocks repriced. When the market sells off, your dollars buy more shares. That's the system working. Now, if you're a high frequency mover, stand aside into Monday, at least. FOMC on Wednesday is the event that could set the direction for the rest of the summer. There's no edge in guessing before the Fed speaks. Let the durable goods and the GDP on Monday set the tone. Let the Fed on Wednesday set the direction. Then you have clarity. Trading into FOMC meeting is a coin flip, and we do not flip coins. The market rotated this week. Your portfolio handled it. At least I hope so. Next week brings GDP, the Fed, and the wage data. That's the real information that you need to keep an eye on. So be patient and let it come to you. I am Carrie with Luxentrics Capital, and I will see you on market open on Monday.